Oh, greetings. Good afternoon, evening, good morning, wherever you may be. This is Steve Hill with AIQ Systems. I'd like to welcome you to this session where we'll be covering some what and how on ETFs, exchange traded funds, within TradingExpert Pro. And we've covered some of this before, and I'm sure many of you are familiar with the exchange traded funds and what they can do for us. We'll start at some of the different families that we already have available to us. And what I've been doing recently is experimenting in different areas in the program of taking the lists of funds and running them through the tools that we have to see if we can find the best tool set for making trades on these funds. Now, of course, ETFs cover everything these days, from Bitcoin to obviously sectors that the US market, from international markets. Also, individual stocks also have ETFs that can mirror them as well. So there's lots of different ETFs out there. I just wanted to give you an idea of what the sort of lists that I've been dealing with recently. These include things like ETFs that are in the directions that you can see on the screen right there. Give me a second here, and we'll just move this down a second. Move my Zoom bar out of the way. So I have in on the screen here the AIQ charts showing. Oh, by the way, can everybody hear me okay? If you pop a Y in the chat area. Great, thanks, Greg. Appreciate it. So what we have here is the regular charting area up on the screen with candlesticks. I have lists that I've created, and I'm sure many of you created lists, different ETFs and different stocks. Within my rather extensive list in here, I have several sort of subsections of ETFs, both all-encompassing ETFs, things like all ETFs, Direxion, where we spent some time a couple of years back actually looking at the Direxion family of ETFs, and we broke them down into, this is all of the ETFs, which you can currently see listed on the right of the screen. And then also we have a breakdown in there of the, put that back up here, different types of directions. I broke them down into the 3x, those are 3 times leveraged. So when whatever underlying the ETF is attempting to mirror, when the underlying moves up 3 points, for example, the 3x ETF would move up 3 times that. And of course, unfortunately, if it goes in the opposite direction, then it moves down. There was also, we broke them down into fixed international market ones, non-leveraged sectors, and stock-related ones. So those lists I can make available for anyone who wants to do a little bit of zooming in or microscopic look at the sort of subsection family. And I picked directions. There are other families, Fidelity, of course, and ProShares. And we have some of those in here as well. And I'm going to make these available for everybody, just so you can have a look at them if you want to just focus on a particular family of funds. So, for example, I've got Pro Sectors and Pro Shares Index also created into a list on independent of the other ETFs that we have in the system here. So a couple of things just wanted to point out with exchange traded funds. Number one, they're very, very heavily traded, at least the top 200 or 300 are. And we'll see a little bit later what I've been looking at, trying to expand the universe of exchange traded funds so that we have almost like a whole market for us to delve into, to mine for trades. One thing I noticed with some ETF lists out there, you end up with, if you have a list of all the ETFs or all the major ones, you may be in a situation where you'll have 4 or 5 ETFs that are really doing the same thing. Those ETFs could all be following the S&P 500. So each family probably has 1 or 2, maybe 3 ETFs that mirror each major index, whether it's a single, as I call the just standard mirroring, or you've got the 2x or you've got the 3x. So there could be some very, a large number of tickers you could have if you have a generalized list of ETFs where you're just looking at the same price pattern each time. So what does that mean? So it would be like if you had a database of stocks where you had 20 copies of Apple in there and 20 copies of Tesla, for example. If the rule fired on Tesla, then there'd be 20 different Teslas that the rule would fire on. So that is something I've seen happen in ETF rotation strategies that I've been looking at over the years. So to avoid that, there's one or two things you can do. That is stick to a family. So in a family of like directions here, which we'll use in the examples today, we'll be limiting the number of ETFs that actually mirror what a stock is doing, or mirror what a market's doing, or mirror what a particular sector's doing. We won't end up with 10 different ETFs that all watch or move exactly as SPX or the Qs move. Interestingly enough, the most actively traded ETFs, which I do have in a page here. I'll pop this. This is a Verify, which just gives us the most popular ETFs by trading volume. So what's interesting here is that the most active is the SQQs, the ProShares Ultra Short Qs. But look at the volume here. So we know liquidity is massive, 138 million shares. That's the average daily share volume over a 3-month period. And the second one down is the TQs, which of course is the ProShares Ultra Pro going in the opposite direction. But boy, that's way behind what the Ultra Short. So that's an interesting a point there, that a lot of people trading the Ultra Short Qs. SPY, of course, we know that's very, very popular, 68 million shares traded each day. And as you go on down the list here, this particular list is, we've got triple Qs down here itself. There's a whole different section of families within here. You've got iShares, of course, Direxion is in here. VanEck, you got a few of VanEck ones. Of course, ProShares we already said. And when we get down here, there's a couple of sort of more recent ones I call, like the Grayscale Bitcoin Trust, which is fairly well known as well, of course. And there's some others in here, like the Energy Sector Spider Fund, XLE, XLF, and things like that are in there as well. When you get down to like the bottom of 100, the bottom of the 100 here, and I've had a rule of thumb with trading. I mean, if anything trades under 500,000 shares, I'm not really interested in it. Look at the 100th most traded. It's still trading 4 million shares a day. So there's a huge amount of ETFs out there that we have it's like a giant mine for us to go in and look for. Again, ETFs versus doing stocks, it's just ETFs gives us a little bit more safety in my mind. Most times ETFs aren't prone to sudden earnings news or catastrophic business news that affects individual stocks that we may be holding at that time, something that we have very little control of. But with ETFs, because you're dealing often with baskets of stocks, and you're dealing with baskets of leverage items as well, if you're trying to mirror some of the movements in the markets, you don't tend to get that happening. The only time you might see that being an issue is ETFs that mirror individual stocks, which case they are a little bit prone to what happens. Obviously, if there's a catastrophic event on an individual stock, then we're going to see that reflected in that ETF itself. So let me go back into the software here. Take a look at this list of here. If you've not been through Direxion's entire list of their ETFs, you can see here the list is fairly comprehensive. I'm missing a couple from my database. You can see them whited out there. I did actually cull from the database a couple of the Direxion ones which had very low volume. So that's the one thing to be aware of with these types of ETFs, is looking out for volume. So look at this one here. This is Direxion's Daily Transportation Bullish. It's only got, remember, for a volume for us, 57 is 57,000 shares traded a day. That is not a great deal. So that's one thing to bear in mind when you're dealing with a family of ETFs and you're looking to use that as a rotation strategy. The volume can be a factor. Ones like this, 112,000 in there daily. This is a Google Bear 1X show. Remember saying this matches what Google is doing. So again, that's prone to this type of movement here, where Google drops from this level to this level. the ETF does the equivalent in its price level right here. And if we were to overlay Google on here, you'd see pretty close comparison on the price chart. So we'll use the Direxion family, bearing that in mind, and we'll see actually there is a strategy that we have actually within the system that allows us to filter out some of these lower volumes ETFs, so it won't pick them as part of a trade. So one of the most widely used methodologies for rotating around ETFs, and especially if you're using just one family, is to use something like a relative strength. Relative strength, which is a tried and tested method of buying into the strength within a given ticker. And there are definitely pros and cons in doing that. One of the pros is, of course, you're kind of buying into the trend. One of the cons is that you could be buying into a trend that's almost over. But it's widely used, and you can actually take the existing reports within the system. I've got them open here, and actually run them, of course, on the ETF family that you want to run it on. So in this case here, I'm in the report area. I go to global properties in here. This is currently selected to the pro sectors. So I have it running just on the pro funds sector ETF. So I'm kind of doing a rotation strategy, but using stock reports. So that gives us a little bit more information. We can use any number of these tools to actually slice into those ETFs to find which ones are trending strong, price change upside, downside, persistent money flow. In this case, what we're looking at here is the strong relative strength ranking report on the long term, and here's the short term as well. So relative strength, quick recap on what that does. It looks at price change over two periods of time, one longer period of time and one shorter period of time. The shorter period of time is given greater strength as far as being assigned a relative strength value. And we do a relative strength ranking of our own called RSR within the reports here. So generally, tickers that are at the top of this report here have had a good intermediate term relative strength, i.e. their trend has been pretty good intermediate term, and they've been doing even better in the most recent quarter. And usually it's done over a year, so you do the 1/3 year and the most immediate quarter. Both of those two are combined together with greater weight given to that most recent quarter. So it's a very, I would say, a conservative type of trading strategy. We've done analytics in the past, over 30 years of this on rotating. You could take the top three funds within a given family that are in this report and buy those, and then run the report again a month later, and then rotate to whatever's in the top three in there. David Vomand, who runs a number of newsletter services and a money manager and worked with us for many years, uses that type of rotational strategy for his money. And again, it's one of those where there are various parameters you can apply in there, but it's a very simple strategy. You run it, you take the top 2 or 3 stocks, you run it again a month later, and then you just change your positions to whatever's the top 2 or 3. If the ETFs haven't changed in there, you don't make any changes. A very simple, very conservative strategy. We could change this and have a look at what it would mean when you run this on a group of ETFs like the Direxions. Because you notice in here, we've got matching all the sectors in here. So it's nice. You're doing a sector rotational ETFs based upon relative strength. If we go into the global properties here and we pick out the Direxions, the full list of Direxions ETFs, which remember includes quite a number of fairly what I would call averagely traded ETFs. If I generate this for, I can generate this for 516. Although I do have some data for tonight. So it's just going to generate this. I don't have groups or particularly I want to run in here, and I don't particularly care about mutual funds. All I'm after is getting the stock reports at the moment. That's because there's no data in there. So what we've done here is just very quickly there, we've run the relative strength report. Remember the same, the relative strength, we know you're buying into the trend is your friend. In the most recent quarter, it has more weight than others, than the other 3 quarters. The report here is much more extensive. Remember, every ticker gets assigned a relative strength, so they're all in here. In this case, we're doing it just on the directions. You notice here, when you run this, look at the ones that are the very, very top here. These are all of the ETFs that are having the strongest trend up and are accelerating at this particular time. And you notice in here, you've got this is the Direxion Daily China Bull 3 times. So that's a pretty powerful, volatile ETF that you have up there. And then down here, something that's a little more likely, which is very powerful, non-Direxion Daily Semiconductor Bull 3 times. And again, there's another Chinese one here right there. So you notice here that you've got all of these, the 3X ones. Notice all the 3X ones and where they are positioned in here. As you go down the list, some of the others are, there's less of them. It's not surprising because the 3 times tend to be, move very, very quickly. Remember, they're moving 3 times as fast as the underlying ticker or market that they're attempting to match. So with families like this, when you're using, 3X in there, the volatility, the fact that they move so fast, means that doing a sort of relative strength rotational strategy might be something you want to think twice about. Because the next time you run this report, if you run it 30 days from now, that 3X could have moved a long way in the opposite direction, which was one of the reasons why I broke out Direxion ETFs into families like 3X, 2X, and then just the one-to-one. To give it a little bit, if you want something that's more volatile, then yeah, you could go with the 3X. So you can see here, with something like this, you've got to be a little bit more aware of having all of those 3X ETFs in there and just how volatile they are. And if we look at them in the end, it's just I'll double click on this and I'll pop it in the chart. You can see here how far and fast this can move. I mean, it's doubled in value in the last 45 days. And it could just as easily do the same and go in the opposite direction. So if you're running something that's every 30 days, when this is where you're in, you could be in here, and then 30 days later it could be down here. So it's very much something to be aware of. By the way, the volume on this particular ETF is pretty significant. As you can see over here, the volume is in the millions. So that's something to bear in mind with that particular report. There are other reports, of course, in here that we can look at. I won't spend too much time in the other reports at the moment because I'm going to move into the expert design studio area and test some strategies for us. The other ones in here, we have, the relative strength week. Not particularly interested in this because we've got long and short within this report here. So really, when if there's something that's going to be bearish, or bearish is happening, and an ETF that follows bearish action, it's going to be in here towards the top of the report if we're in a bearish market. The other areas down here, the one other thing is volume spikes were one I looked at before. Again, you'll see in here, there are occasions where you get big spikes in volume in some of these, like this one here. This is a Direxion Bull 3X. I'm just going to have a quick look at this one because it's got a really big volume spike right here. Now, this could be a legitimate volume or it could be an error in volume. The volume on this particular one is not huge on an average basis. It's like 210,000 shares, but 4 million shares. That's a big move there. And look what this big bar happened here. So something happened on that day. So that's the sort of thing I keep aware of when you see that happening. This is obviously in this situation, there could be something that drastic has changed. I don't know exactly which one that is, what it's actually matching. But keep an eye out for those volume spikes. They very occasionally occur. So the one other thing in here, I just wanted to show, this is a mechanical thing really, as far as making lists and doing things that I've been doing. And I know some of you have been too. When you look at this this list like here, I use this Veta because it's really easy for me to literally, what I did here to make a list I'll show in a moment was I just highlighted all of this data, 100 ETFs. I threw it into a spreadsheet and got rid of the columns I didn't want. I just want the tickers. And then I can take those tickers. So I've got just a CSV file, comma delimited file. That's all I have. I then go into Data Manager. And what we do is we go into List on the menu here and go to Advanced List Edit. And I've already got it open here. I'm going to open a second copy. But many of you may not have been in here. Advanced List Edit. You can see here I've got a few screens open. I'll just blow this up a bit. What you can do in here is you can open up different lists, more than one list, which as you can see here, I've got several. I will just, I will change icons so you can see them better. Yeah. So I've got several different lists I've opened here, ETF lists that I have within the system. There's that directions one we've been looking at. Here's an ETF rotation one I've used in the past using some iShares. What you can do in here is individually or as a list, you can actually transfer and move around lists from one place to another. So I can click and drag and throw this whole list into here and combine the two together. And so that allows me actually to build a list of all the, I can take all the ETFs in my database, which are all segmented into different lists, and throw them into one great big list. I could do it that way. But what I've wanted to do was I got that list, that list of tickers, which was actually an Excel spreadsheet. We'll just quickly look at that. I don't want to spend too long in this one, but that web page we were looking at, and this is 100 most traded ETFs, and it's just a CSV file. And those are the tickers. Remember, SQQQ is the top traded ones. This I actually imported into here. I created a new list called ETFs 100. So it's the top 100 ETFs. And when I'm highlighted on that list, I can literally go to here and find and import. And I imported that CSV file into here, and it created this list for me. I've got all the figures in there. There might be a few of them missing. Actually, I should have them all in the database by now. So that list, once it's created and I shut this down, I actually have this. No, I don't want to change changes to that. And if I go into here, you have ETFs 100 list in the data manager here. This I created and I imported all of those symbols. And those that were missing, I just added into my database. And so now I have an ETF for 100 most liquid ETFs. So I'm pretty safe that's a good list to go test with. So we can take that list and we can look at it in a couple of strategies next. So again, I could also take that ETF list, ETFs 100. Since it's in the system, I can run it within our canned reports just by going to global properties here. Moving down to the ETFs 100, there it is right there. And I click OK, and I'll just generate it all for, actually, let's just generate the relative strength report for just that selected report, and we'll do that for yesterday. Nope, no data, so I didn't update it yet. So that might explain why I don't have all the data in there at the moment. So that list is still, that's one I've just created, of course. So it's ETFs. Let's go look at it in here, 100. And there's the list in there. Yes, I just need to do a bit more updating. Some of the tickers are not fully updated yet. So we can run that in there, or we can also run the list of tickers that we have here through Expert Design Studio, and like we can with the list we were looking at earlier. So I've already prepared some of this for you, so we don't have to go searching around. And there's a couple of ETF strategies I want to look at. First, I want to throw out here again relative strength, but this is relative strength using a more traditional method that you might be more familiar with if you've ever been with Investors Business Daily and the way this was originally calculated. We have a relative strength trading Expert Design Studio file. So for those of you who don't ever use Expert Design Studio, it is available within the main menu. Let's pop that up here a moment. think this might be on my other screen. Yeah. So the Expert Design Studio is launched from the main menu. I'll just show you. This is right here. By the way, don't worry about that Winway. This is from an earlier session I was doing. And that Expert Design Studio allows us to write and build trading systems. And it also includes a lot of CAN systems within the system itself that we've sent along with the software. This one I've been working on. We did a session a couple of months back, which was relative strength trading for ETFs. And what this gives us, and by the way, I have this currently run on the Pro Select ETFs, but I can also change that to the directions that we were looking at before, or another list, depending what I want to look at, or the 100. Let's do the ETFs 100. So I can run this on that. I've got it set for 516 there at the moment. So I can run this, and what this will give me is, again, relative strength. There's a more traditional rank, relative strength, because we can sort by the column here. It also gives me the percentage price change. So this is a little more refined here. I can just get some very basic details. I want good relative strength, and I want the ones with the best percentage price change. And this, again, will be a rotational strategy where you could move within every 30 days from the top ETFs within that report. We just run it real quick, and you can see how it runs here. Notice some of these I don't have a description in because I only just added those in when I imported that database. But you can see here how quickly that can operate and how quickly we can get the information here. And it's a different, remember, this is a different look than what you get within the reports themselves. When I click this tab here for the rule library, it shows me how this relative strength is created. And this one is a 120-day and a 30-day. So look at the periods that it's done over. It's done over a slightly different period. This is a shorter term period for us to look at. So I can vary this if I'm more interested in being an even more short term as far as how long the strength has been in place. So that's another good area to be in. That relative strength trading for ETFs is pre-built now. I can make it available for you. It is actually already available within our blog area on the website. So let's see. We are moving into more of Expert Design Studio. So there are a couple of strategies out there that we've tried and looked at recently that have been working for stocks. And there are a couple of strategies back from a long time ago that I still like a lot, and I still use on occasion. One of those is from Jeff Cooper's Hit and Run Trading. This strategy was called Boomer Buy, and it's it's out there. It's pretty much available. This was something he built some time ago, maybe 30 years ago, 25 years ago at least, and it's a great straightforward strategy using ADX, and there's also some what we call inside days built into there. And the strategy itself, when you run it on a database, it's called Boomer Buy, and you get this ADX direction, an inside day on 3 and 4, 1, 3, 2, 3, and 4, I think it is, and that's the sort of pattern that he was looking for a going long. So again, I have the ability in here to go to properties and decide what I want to run this on. So here it is set to run on the ETFs 100. So this is the process you go through within the Expert Design Studio. Is first off, you need a strategy. So where does this strategy come from? Well, as I said, this was canned, and I know many of you will know this, but when you go to File and Open, and in here, there is a folder, Wintest32, where the software lives, and EDS Strategies is inside that. And inside that is a bunch of subfolders, and these contain, a couple of hundred different strategies. And this particular strategy, Boomer Buy, is in one that we put together many years ago that still hangs out there really well, highest ROI rules. And so I opened that up, and we have it open right now. And I can then run this on whatever subsection of stocks I want to run it on. So in this case, as I said up here, I have it running on the ETFs 100, that list that we just created of those ETFs, and I added the ones that were missing. So I've got the top 100 most highly traded ETFs, and I can run this in here every day to see if it's going to fire. What you can also do, and what I've already done in here, is create a back test on this. First thing I do, once the rule's in here, once I know what list I'm running it on, I create a back test. And we go new back test. It's already been created for me here when I did this earlier. And what the back test does is it allows me to run this strategy through a period of time to see how effective it is. So let's have a quick look at what this is. So when you create a back test for that boomer buy, and this is doing it just on those ETF 100. So we've only got 100 tickers. And this strategy is it's a nice strategy, but it doesn't fire that frequently. So what are we doing here? Well, it's the boomer buy. We know that's the strategy, that ADX and inside day combination. I can test it back. In this case, I'm testing it back 48 months, 4 years, right? See how often it fired in 4 years. I'm just going to buy the next open once it's fired. And when I exit, I'm exiting based upon money management rules again. The rules here are entirely up to you, but this is a fairly loose on the profit side. So a trading stop of 80%. If it goes up and comes back down, I want to keep 80% of that. I'm willing to lose 20% of my initial investment. So it allows a little bit of drawdown on this before it might move in my favor. Or if it keeps going down, it's going to get me out. And again, if my profit goes above 5%, I can change this as well. I want to save 80% of that if it starts to fall back. So got different ways of exiting the boomer buy. Nothing as far as a technical pattern or rule, although you can have a rule, which is what this area here allows us to do. So on the boomer buy, when I ran this, so back 4 years, as I said, this is a very tight strategy. And running it just on that list of ETFs 100. So you can see this is the interval. ETFs 100. Here's my exiting strategy. So you get all this information. Here's the period I ran it over. It's a pretty interesting period, right? From the middle of May 2020 all the way to the middle of May here. So we're a pandemic world all the way up to the current day. So we know there's been some pretty good volatile times. What's interesting is that, remember, there's 100 tickers in here over 4 years. It only fired literally 2.5 times a year. So not a lot of trades doing this one. That's not terrible if the trades are good, but the more trades we have, or the more significant number of trades, the more effective the strategy would be. But as one strategy, as a collection of strategies, then this is not too bad, because what this strategy does and the way it works, we're exiting only on money management at the moment. The average profit and loss on each position was 4.73%. During that same period when the position was held, it's outdoing the market almost by close to 5 times. So it does a pretty good job. It does a pretty good job overall. And you've got 10 winners and 1 loser. It's not bad ratio. I mean, reward risk ratio 3.2, but not a lot of trade. You need more tickers in here. If trading 2.5 times a year is not something I'm going to do. But if I was using this as part of an armory of trading strategies, this might be a good one to bear in mind. So that's boomer buy. Look what it bought. I mean, it's not like it just bought one ETF and one was the big winner. Look at this here. You've got actually profit drawdown. The profit here, you can see it's spread across the board. There are a couple that made only a small amount. So there's the one loser here, just one. Not bad, really. Not bad at all. So again, 3 things we've got going on here. We're using ETFs, which gives us less risk as far as having news damaging things causing problems for us. The ETFs themselves, we're using the top 100 ETFs. So all of these have got high liquidity. No problem in getting in. Good bid-ask spread on all of these. And it's a good diverse mix of you've got a gold-based one, and you've got a cryptocurrency-based one here. So you've got several different ones, semiconductor-based. So it got SPY as well. So it gives you a nice little mix of tickers that it buys into. So interesting strategy, but not not a huge number of trades. So I moved on to look at another strategy that's also in that highest ROIs, which is one built by Rich Denning, one of our clients, and a great a great writer of strategies actually. I first off pulled up the Rich Denning, the Denning VCR. I do love this strategy. Again, it's a really, really in-depth strategy. It's been very, very well tested over the years. I won't go into all the details here. One thing he does have is a data filter, so we can run this on a less cleaned database rather than ETFs 100. We could do it on an even bigger database because there's a data filter in here that will allow us, will make sure we don't buy into any ETFs that have low volume. So this, his strategy has money flow involved in there, money flow RSI, average true range, and there's also RSI wilder. So it's a combination strategy. It also has an exiting strategy in here. So it's a pretty good strategy overall. And so for going long, remember, we're doing ETFs. Instead of having a short strategy and a long strategy, that's a great thing with all these ETFs. We've got a bundle of ETFs that both do long and short. We don't have to think about going short ever. We're always buying. We're always buying because those ETFs that match the bearish will be in them when we need to be in them. But we're owning them rather than going short. I'd never like going short. So the rule itself, I'm not too concerned about that. What I want to show you here is in this particular case, the properties in here. I had this one, I was running tests on this on all ETFs to see how that went. And I ran a back test on this. So again, remember, I can create a back test that runs that rule. So I ran this for all ETFs. Now, this list of all the ETFs is quite big. And in this case, I ran it again. And let me show you the parameters in here. This was run over a 4-year period. So again, that great period. The reward risk ratio is pretty high, and the winners to losers is pretty good as well. So that's that's a good sign. But remember, you're buying long and short. That's the great thing about it. If you've just got a long strategy, when markets are going down, the long strategy may fire, but you're going to pick stocks that may not stay or may not go up or may go down. Whereas in here, you're more likely when the market starts going in an opposite direction, it's more likely to pick an ETF that's going to follow on in that direction. So again, not a huge number of trades, but much better than the one in the boomer buy that we were looking at. 56 trades, 39 winners, 17 losers, pretty good. Again, this time it's compared to the NASDAQ 100. So it outperformed the NASDAQ 100 average loss per position. But the one thing I noticed with this, it has an exit strategy. I'll show you that. That's why the number of days here, this is a really quick trade. So it's 4 days. 4 days is really what you're in for. And that's because there is a built-in exit strategy already in here. So when I go into this edit here, again, with the range itself, we're back 48 months. So we're going back 4 years, which is perfect. The entry is compared to the NASDAQ 100. We get in at the open the next day. Here's the key thing, the exit here. No money management protection going on here. It's exiting on a long exit that was in the strategy itself. You can experiment with adding these in here, having more exits, or using just money management exits itself. But right now, this is looking pretty good as far as a strategy is concerned. Not a huge number of trades and only held for 4 days. That's pretty low risk, really. You're in and out within a week, right? And you're making money on the majority of these trades. 39 winners, 17 losers. So pretty good all round. Looking at the list of positions it buys over those periods, you can see here again, it's a good mix of tickers. Remember, this list is all ETFs, so it's got some of the lower cap ones in the ones with less trading in there. And what's interesting is that of course, the filter in here, the price filter filters them out, so we don't have to worry about it. So that looks pretty good on a really broad list of ETFs. If I jump around again, I know we only have limited time. I do want to show you this one here. This is another, I ran this again, and this is, again, the same strategy that we were just looking at, that Rich Denning strategy, the one that has the, no, sorry, this is the wrong one. I need the other ETF one. There it is. And let's check this. That's what happens when you have too many windows open. There it is. The ETFs 100. So I've got the same strategy that we were looking at a moment ago, but running on the ETFs 100. So let me just show you the exit long that's down here, just so you know. Exit for long positions here is actually a, it's a very, when I say it's a number of days that you're in a position, that it's a complex piece of work that goes on in there. So you could use that, and I can't even remember explain what's going on with the actual philosophy of that exit, or you could use money management again for exiting the positions. I like the way that you're in for 4 days and then you're out, which is pretty good. So in the case of this particular running, remember, it's still the same. We're going long based upon that ADX RSI, the RSI Wilder, the ADX is down here. And then the average true range, sorry, money flow RSI, average true range, and then the RSI Wilder. So there's some combinations in there. When we go long on this, and I've got the back test here, remember this time we're running on the 100 most traded. So it's a slightly different, this is a little bit of a shorter list actually than doing all ETFs. And this is a good test. So we're trying a different list. And you can see yet again, it's a 4-year period. Because the list was shorter, there's only 19 winners, but 11 losers. And again, when we're looking at the performance, it's the average on each position is 3.4%. So it's pretty good for trading over a very short period of time. When you compare that to something like the Boomer Buy, where you're looking at some of those trades were held for hundreds of days or 150 days versus this is very, very, to me, this is a much lower risk. So again, you could be using either the 100 most actively traded ETFs, or, and this is the other thing I can do, I can actually go and get the 200 most actively traded ETFs. And I'm betting I can still get down maybe halfway down that list to see a level where there's still enough liquidity to feel safe getting in and out of that ETF. So if I was to use that and put that into this particular strategy, we could be looking at anywhere from 60 to 80 trades over a 4-year period, maybe 20 trades a year. So again, still not bad, and you're only holding for 4 days. I like that. It's really good. There are many other ways of slicing this up, but I don't want to, we could go and delve into this for hours on end. There's so many things that variables out there. We don't want to spend so much time on too many variables. We need to have a list. We need to have that list available. That most liquid, ETF doesn't change a lot, so we don't have to keep changing that list. And I think probably 150 to 200 ETFs would give us a good pool of ETFs to mine, and then to take those tickers and trade them. You can see this stuff works pretty well. And so really that's as far as we've got with looking at methods within AIQ of slicing up the ETF marketplace. I'm very happy to make available to you as many of these ETFs lists as I possibly can. Once the recording gets rendered, we can make that available to you. And same goes for these EDS strategies. Questions on EDS, there's videos on the website, on the support area, that will help you get some insight on how all of this works and hangs together. We've, in the past, we've done sessions where we've done basics on EDS, and it is, it's a great tool. It has a wizard built in there that allows you to create strategies both from scratch or building using the wizard itself. So that's pretty much it today. Just a 45-minute session. I'm currently in our UK office, so it's actually 10:45 in the evening here. If you've got some questions, pop them into the chat area if you would, and I'll endeavor to answer them. If not, I will be available. Just send me an email, shill@aiqsystems.com, and I'll answer the questions. If it's technical, send it to support@aiqsystems.com, and they will answer the questions. And I think you'll agree, ETFs, and if you're not trading them, it's really worth looking into just doing ETFs. I feel much happier in ETFs rather than that risk that comes with owning a stock. And really, that Rich Denning strategy with the 4 days, it's been around for so many years, just like Jeff Cooper's Boomer Buy. Those strategies have been around and tried and tested, and I think they still have some relevancy today. And as you can see, running them using a back test in the exchange traded funds, it works on them just as it works on stocks. And so, yep, that's it. So it's either relative strength is a simpler strategy, but if you run relative strength rotating from the top relative strength stocks, say every 30 days, I do think you need to keep in mind that the more volatile ETFs, the 3X and 2X, are not suitable candidates to be in there. You might want to stick with the ETFs that match just the markets, or the sector one, I think, is the best for the relative strength, because then you're doing sector rotation, which is, again, a relatively safe place for trading. So that's it. If there's no questions, if not, pop them in chat. And if not, I'm going to wrap it up and call it a night in a couple of minutes. Great. Thanks, everyone. Have a great evening, morning, wherever you may be. And we'll be back on the air again, probably towards the latter part of the month. I'm going to put another session on. We haven't decided on the topic yet, although we may be moving into some candlestick strategies next. By the way, if there's anybody here who's not currently on AIQ, just go to aiqeducation.com, and you'll see actually on the website there is a link to a trial copy of the platform, and you can download that for $1. You get the data included in the first month. Great, thanks everybody. Have a great evening.